All right, so with all the noise this week about GameStop and Redditors and Wall Street Bets and Robinhood and brokerages letting you trade or not, with all this hubbub, which really didn't impact the majority of investors or even traders out there, what's underlying what this might be the catalyst for our exhale. This exhale that we always get, right? You breathe in, you breathe out. So is this the catalyst? And is this a great? I mean, it's not a market, it's not a trend changing catalyst. It's not like this is going to lead us like COVID, which obviously can really impact the economy and shut things down. So it's not that kind of catalyst. But if it can be a catalyst that just gives us a breather. And then we can get going on this really good earnings and economic data we're getting, recovering, and get going again. Great. Then that's all we need all this noise for. So I'm going to break down the technical signals, but that's kind of hiding beneath all this, within all this noise that suggests what we might expect next week and beyond. So I'm going to break that down with our trade idea to take advantage. So let's go ahead and get started. Today is Friday, January the 29th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and take a look at the S&P 500 first with the market forecast indicator like we always do. So we'll start off taking a look at today's drop, which got right down to the 23% retracement level. When we were doing our technical analysis class today, we were at the lows of the day. And we started actually throughout that hour rising. But at the lows of the day, we were looking pretty bearish. In fact, we were below the 1.5% mark, below the 30-day moving average. That's a key level that we look for, as you can see here. If I go 130 here on the simple, that's a pretty important level. And we were down. We're only down to 1 1/3 by the end of the day, but we were down to the 1.5% mark. That would have been significant because that's the level we look for to see, are we actually starting? Like, it's one thing to get light pink shading and yellow line, but it's actually a very bullish pattern to get, like I mentioned on Wednesday. It's a very bullish. We actually didn't have it on Wednesday because we were still light green, we were still dark green shading, but we do have it now, light pink shading and yellow line. But not all. I mean, eventually a light pink shading and yellow line can turn into like over here, like this one did. We bounced off of that one too, but this one, light pink shading and yellow, or pink shading and yellow line, did turn down. So eventually there's going to be a light pink shading and a yellow line that turns into a dark pink shading and a red line. But a lot of times it's pretty darn bullish. But the kind of, how do I know? I mean, nothing's 100%, but how do I know which one it will turn into? Well, how far down below the moving average are we to get the yellow line? If we're within 1.5%, great. Good chance, not 100%, but good chance we bounce back up. If we're below 1.5%, good chance, again, not 100%, but good chance we keep going down to dark pink shading and the red line up here. So we're flirting with that right now. And again, with the 23% markers also, you get below that level, that's a significant. Now we're 6 points below that level, but we're kind of splitting hairs here. So I wouldn't say, well, we're below the 23%, here's the pullback, as we'll see some other indicators here in a second. But you can see just how close we are because we're followed through on Wednesday's move, actually closed below Wednesday's low point after bouncing up on Thursday, and we're continuing lower. If I look more broadly than just the S&P, you can see the Russell 2000. While we are getting some pretty bearish short-term sentiment, not too extreme, we're not getting light pink shading and yellow line because we're not below the moving average at all, and we're not below the 23% retracement either. And if you look at the Nasdaq 100, you'll see here we are getting light pink shading and yellow line, but like very, very light. I mean, very small number. In fact, let's come over here. Let's go to NDX on this chart. And you can see we're only 0.13% below. So very, very minimal yellow line there. And you can see, let me get rid of this near-term retracement, which happens to be at the 73. But you can see we're also sitting right on the 23% retracement for that too. So again, we're kind of in this mode like we were Wednesday where, we're not really broadly like, here we go to the downside. The late rally in equities really kind of helped things stave off the inevitability of, or the how imminent the beginning of this intermediate pullback that we will get at some point, because stocks don't go up forever, as crazy as that sounds. But we will get this kind of move. We just had a few months ago. We might forget, but we just had an intermediate pullback. It was one of the weakest intermediate pullbacks we've ever seen, but it was an intermediate pullback nonetheless before this 3-month move started here since. So looking at all the other indicators, all the other indexes, we're not really getting a broad kind of selling, but dang, we are close. You can see over here we eventually got to what was that, right on this day we were at 1.48%, and then the next day we were at 2.5%, and that was like, okay, now we are getting that intermediate decline. It eventually broke the 23% retracement over here. And that's about all we got. We didn't even get close to the 38. I think we will get a lot closer. In fact, I think we'll get down eventually. By the time the intermediate pullback ends, whenever it starts and however long it lasts, I think we'll eventually get down to the 62% and probably stay in the retracement zone for a period of time, like weeks, a month, maybe 2, until we get a new period like this of dark green shading and green line again. So that's kind of how things are setting up on the market forecast indicator. It is the end of the week, so we can take a look at the weekly chart too. You'll notice that the weekly chart is showing a intermediate confirmation signal. So strong bullish posture and an oversold momentum line. So it is a engulfing pattern here, but you can kind of see like you would, and the near-term line's almost done. It didn't quite get below 50, but this kind of period of bearishness is almost done. And if you look at the candle, it looks like a pretty decent transition candle on the Hakinyashi here. There's still probably a pretty decent chance though that we get like maybe one more really short near-term rally out of this before things really get started to the downside. It's kind of what the weekly candle, and then you look at the monthly candle, because this is also the end of a month, and you can see, okay, well, we have an oversold, an intermediate confirmation signal here too, where we have a strong bullish posture. The near-term run just barely started, and you have so this would suggest February will probably be a pretty decently bullish month, especially with its Hakinyashis. We haven't had a transition yet. Like we did in February of 2020. So there's a pretty decent chance that we could still get a bullish February, even if there's a week or two of weakness, either at the beginning or at the end. I think probably more towards the middle to end of February. By the time we get that intermediate weakness, that won't be too weak to cause too much turnover, and then potentially by the end of March we get going back to the upside again. So obviously we finished the week about as weak as you can finish, but not weak enough to say qualitatively that we are beginning a pullback now. In fact, like I said on Wednesday, I'm probably leaning more towards there's a pretty decent chance we bounce right off of this level and start next week on a positive note. So we'll see, because short term anything can happen, but that's the direction I'm leaning based on how we finished the day today on a relatively high note, as bearish as we were at the lows of the day. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things: that you liked our video today, and that you want us to do another video again tomorrow. Quick way to give us feedback. If you don't like our videos, of course, you don't even have to watch them. But if you do like our videos and you want to let us know, you can do that with one click right there. Again, you can do it even right now while you're watching. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? What did you get out of it? Share that with our viewing community down below as well. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Join our website, follow me on Twitter for more content in between the videos from day to day. It's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these other things on the right, including the Market Outlook Live. So every day I do the Market Outlook, I do a live video. I review all the old trades. We close a few Market Outlook trades today. In fact, I closed out this morning and sent those trades to our premium subscribers. One of the resources they get, one of the premium resources that our premium subscribers get, is our Telegram account, where we send all the trades that we do in between classes or Market Outlook videos during the day, so you can see what's going on there. So I sent those trades out earlier today, but I put on today's trade idea already before the market closed. You can also see one of the other premium resources that's been getting a lot of views lately are updated charts. Brandon went through and updated all of our charts there. So make sure if you're a premium subscriber, you get access to those charts all these charts I use in the Market Outlook videos and we use in our classes. You get access to those too. Again, they're here premium resources. And remember, our premium subscribers that started with us a few years ago when we very first started, that are up renewing now, you get that discount. So make sure that you let me know if you didn't get that email with the link to discount for to renew with the discount. Send me an email, I'll get that out to you. Come down here, hit that like button or heart. It opens up this page. Hit that like button right there. Same thing, hit this thumbs up, opens up another new tab. Hit this like button here too, right there. Again, the more you do that, the more our videos are reached by more and more people. You can see we have, I have like 50, over 1,000 at least people that follow my page, my Facebook page, but it only sees 107 people. So the more people hit the likes, the more Facebook will show it to all of our followers, not just 107 of them. It also benefits you too, because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, let's take a look at some other of these charts and see how things are going here. Now you notice we did get a transition candle. And that's a pretty significant transition candle, a lot more of a transition candle than what we saw there. So that actually kind of leads to the idea that we might be leaning more to the downside next week. So again, something like you see over here in October of 18, over here on the left, before we had that week on October the 8th. So that's a pretty decent indication that we might be leaning towards the downside. I think we might get another day or two of upside, but by the end of the week, that says we could end up with a pretty bearish week. So obviously we'll know very quickly, because we're sitting right on the make or break point, right? Basically right on top of it there at that 23% Fibonacci level. Looking at the three green arrows, you can see we broke below the 17-day Wednesday, and we did get back above it and the 8-day yesterday, but then closed back below it. So here's another indication, the fact that we got below the 17 and now have stayed below the 17. That's a pretty decent indication too that that we might be rolling over next week instead of bouncing up. In fact, if I activate this, you can see how, again, how we're right on the door of that. That's the make or break line right there. And you can see the MACD is at its make or break line at 0, and the stochastics is at its make or break line at 50. And they're both got pretty steep angles, so it's not like we're like gradually moving towards it and there's a chance we could just pop up. Those are some pretty steep angles. Now you notice, over here we had some pretty steep angles and stopped, but that was with some, one candle that kind of caused that and not multiple. So again, kind of another sign that we might be leaning in that direction. If you look at the DMI, the positive index is negative, is well above 30. It's approaching that kind of significant level, right? We usually get the significant moves early, not late, right? Which this is the anomaly where we got it late, and even then it wasn't very big. It never did get above 40. But we could very well get if we break that line Monday morning, especially if we end up with a gap on Monday morning, if we end up not Sunday night, because we've been getting some pretty significant gaps in Asia, Asian trading, but by the time the European market really gets into full sway, we don't get very much of a gap. But if we end up with like a 1.5% gap by the time Monday morning rolls around, now we're looking at something. Now there's a good, obviously we would be below the break even, that make or break point, and we'd be really going down. So we'll know very, very quickly how things are going on Monday. And then again, that kind of a gap would be a kind of a runaway type gap. And in fact, we kind of got this runaway gap going on here, though we did fill in some of that gap. Where was it here? You know, if I come here, we have filled in some of that gap, just not all of it, but that could very well end up being even though it wasn't that significant of a gap. When you look at it down here, you would ideally, the runaway gaps, you know, have a good, I mean, something like this, where you have a good percent, you know, we drop a pretty significant amount, at least one standard deviation, which is the first red line, and we're just not getting that yet. Though we've had a couple 2% drops here, and we usually don't get that in bullish markets, right? When we're on bullish trends, we don't get 2% declines, right? When we get bullish trends, we don't get 2%. Now, we had a few over here because we were so bearish and volatility was so high, but we typically, if you look over the course of time, when you are in bullish moves, we typically don't get 2% pullbacks, right? These are all intermediate pullbacks here when these occur. That's when that intermediate pullback started. This is when that intermediate pullback started, and during the bullish run, we didn't get any 2% declines. Over here, this is an intermediate pullback in the first quarter of 18. We didn't get any 2% declines. Then we got the next intermediate pullback in the fourth quarter of 2018. So you kind of get that idea there. If you look at the RSI and the CCI, now they're kind of suggesting we are kind of moving towards the lower end. You see, we're below the midpoint. When you're in a bullish trend, you're above the midpoint. When you're in the, you know, when you're not anymore, but you're not necessarily in a bearish trend either. You're between this 40 and 50, and sometimes you flirt with the 40 level, and we are below negative 100. So, you know, this kind of suggests that we're leaning towards that. And if you look at the Ichimoku cloud, this also suggests that the trend is done because we broke down the zero. The strong bullish trend has been done. Even though we're still above the cloud, this kind of suggests too that the intermediate pullback might be beginning once we break that line. So a lot of signs suggesting that we're leaning in that direction. Of course, nothing in technical analysis is ever picture perfect because everybody's kind of looking at all these things we talk about here, even if, you know, they might not be too common. None of this is like hardly unique. So nothing's ever picture perfect. So we'll, you know, this again, like I said, make or break point. The volatility index at the lows of the day and at the volatility, the VIX's high of the day, we were sitting right at 105%. That boom, like. That is indicative of the beginnings of an intermediate pullback. But we didn't finish there, right? We got up there, but we didn't finish at the 105% mark. And so that's an important distinction to make. Like we kind of got up there too. Let's see, that's on the, sorry, there we go. We got up there too on the last couple of days here, but more significantly, obviously here today, if I were to go back to the intraday, today, obviously we didn't get that high yesterday or on Wednesday, but that you can kind of see here, you know, that's getting to 105% is the indication that, okay, here we are in the 30s. Like we're not even in the low 20s anymore, so we are in the 30s and we are working our way up. And I did mention, maybe not in the market outlook video, but in class, that before we get this pop to 105%, on this pop to 105%, usually we kind of pop up to the, you know, kind of the neutral zone first when we're at low levels. So we were at relatively low levels. We got kind of a little bit through the neutral zone today, or this week, excuse me, on volatility, and then we might get this pop. And I don't think we're going to go up there because that was our COVID low and death cross environment. But I do think we'll get to this 105% mark by the time we get potentially by next week, if next week ends up being the week that that we break below this make or break point and start this. So you can kind of see how things are working there. One more thing I didn't mention too was the Bollinger Band. So another sign that we are starting that intermediate pullback now is not only do we get below the lower half of the chart, we got into the lower quartile of the chart. That's also another indication that an intermediate pullback is beginning when you're in the lower quartile of the Bollinger Bandwidth, with bandwidth rising. So keep that in mind. There is a little bit of a volume node right where we're at here, right at the top of the value area, so there's some support. But if we were to break through that support, here, let me get rid of the expiring cone. If we were to break through that support right here at this volume node, then you can see, if I get Yeah, so by the time we get to the next area of volume, that's where the bottom of the Fibonacci retracement zone is, the 23% line of the long-term rally. Here, we get rid of these lines here. Sorry, here. That one. So there's the Fibonacci retracement zone, and there's the 23% of the long-term move. So sitting right on top of each other, right on that volume node. So, this not only is this 23% a make or break level from a Fibonacci standpoint, there's a volume node there too with a gap in between that makes it really easy to fill in to the downside there. If you look at the 4-week range, you can see how we're into the lower half of the 4-week range, so another sign that this intermediate decline is beginning. We've been in lower halves before, like over here, so it's not out of the realm of possibility, but we are at the bottom of the value area, and there you can see the path of least resistance to the downside. If I switch this out to a little bit longer of a time frame, to a 90-minute, I guess I have to go to a 30-minute chart to keep it all in the same. You can see, there's some volume here, so there's an opportunity to stop here and come off of this. But if we break through this, again, not very much volume in the last 90 days, not very much volume right there below, down through the retracement zone, right? So in the last 90 days, because we went up so fast here post-election, there's not a whole lot of short-term volume helping to keep it up. Finally, let's take a look at today's volume and trading range. As you can see here, again, volume 126 million. The trading range was 8.5 points, but with about a point of gap. The gap there with a point. So if you add that to, or if you look at this here, you can see, when this line moves up to 2% during intermediate pullbacks, as you saw here, which means you need days above 2% to start pulling this line up. Well, when we started this, 1% move was 4 points. We're getting 8.5 point move, or 9.5 point, 10 point moves. Over here we had double-digit point moves, and you include the gaps on Wednesday. Those are all, again, 2% would be 8 points. So we're above the 2% mark. It's pulling this up. The more we get these bigger numbers on ranges early, then we know we're in the midst of this pullback, especially with volume starting to ramp up. 126 million's here. Again, the higher, it doesn't have to be. If it's up at 300 million, then it's like a one-day sell-off, and we bounce right back up. But, if we're kind of in this range, 125 to 150 million, then that's enough volume to bring this line up, but not too much volume that it's like a washout. So again, you can kind of see from a range and volume standpoint, we're in the areas of these are bearish territories. So we're getting a lot of signals going into the end of the week that the intermediate exhale, and this is not going to be a significant event. Like when I talk about intermediate exhales, I'm just talking about in a month or two of weakness where we come down into this area right here and we just hang around here. We'll go up and down, but we'll just kind of hang around here using this bottom as a support. And we could break through there maybe on an intraday basis, but I think we'll have a pretty good chance of holding some support in that spot. And then that's it, right? That's what I'm talking about. So we're not talking like the end of the world or the market's going to tank or anything like that. It's just, in fact, if we were to get that, it's going to lead to more moves like this going into 2021. I think multiple moves like this going into the rest of this year. So what do you think about that? Do you disagree? Do you agree? Again, this idea that we might get a day or two reprieve early next week, but it's looking more and more like by next week we're going to start breathing out, right? On a more intermediate level. Again, not into the world stuff, just just kind of an extended period of weakness, more than just a short term. Like our periods of weakness lately have been like a day or two. So it's going to be more than that, probably a few weeks, maybe a month or two of staying down, or of going down, and more staying down, right, until we get a good base formed on an intermediate basis, and then start another run like we get. So what do you agree with that? Do you disagree? If you disagree, let me know down below. What are you seeing, or what chart or indicator are you looking at, and that you're willing to share with the rest of our viewing community. as to why you're a lot more bullish than I am, or why you're a lot more bearish than I am, why you think it's going to tank even a lot more than what I have painted here with the targets we're looking at. So share that with us in the comment section below. All right, now let's take a look at what's driving the price action. You can see this is the week that was, and look at small cap stocks dropping more than the Qs. I told you that when this relationship will start to turn over, so it is this one here, when this QQQ IWM relationship starts to roll over here, and let's go to like a, this is on a daily chart, so let's go back to a 1 year chart here. When it starts to turn up, it will start turning up during a period of weakness, not of strength, right? That eventually the Qs will lead to strength higher too, but during a period of weakness, you can see this past week, in fact, let's go to like a, well, you can see the MACD in here, but if we go to a 5-year weekly chart, and disregard the indicators, some of these indicators, because these lines aren't the same. But you can see the week that was. We actually had we followed through on last week. The last 2 weeks have been pretty bullish from an IWM versus QQQ standpoint. The CCI is rolling higher. The RSI on a week-to-week basis is rolling higher too. And again, what that looks like here, oops, excuse me, what it looks like here is, you know, again, IWM is just going down a smidgen more. If I were to go out to that same 2-week time frame, so here, I can go out to like a 20-minute chart, then you can see again, IWM and QQQ is actually up for the last 2 weeks because we rallied there, and the Q and IWM is down 2.5%. So it kind of gives you an idea of what, you know, the small cap strength outperformance was short-lived, which makes sense when there's big disparities. The small cap sectors can't lead for an extended period of time because that's not how market cap weighted indexes work. Market cap weighted indexes mean that the weightings, the sectors with the biggest weightings influence the market the most. The sectors with the small, when there's such wide disparities. So emerging markets also struggling as the dollar was up this week. Gold pressured a little bit by the dollar being up. You know, it underperformed like bonds, but it didn't underperform equities, as it way outperformed. So, when if I were to go now to take a look at how like the dollar performed this week, so let's come back. Let's go to this chart here, and let's take a look at the Euro US dollar. You can kind of see the dark pink shading and red line that's going on here on the daily chart. You can see what the weekly chart looks like. So we're just now getting some weakness here as we pull back, and you notice we stayed this week below the 23% retracement. So we kind of bounced up here, but we stayed this whole week, as well as last week, we stayed below the 23% retracement, and we're getting red lines. So that means the dollar is in a period of strength right now. Again, another sign we're leaning towards the beginning of an intermediate pullback, because we already have gotten below and retested and failed at that 23% retracement. Of course, that's going to have an impact on gold too, and gold might be bearish here for a little bit as well, but on a relative basis versus stocks, obviously that's going to be a benefit. As you saw this week, it actually outpaced equities. Looking at emerging markets too, you can see the weakness starting there. You know, there's an opportunity for this intermediate trend to be done. And if you look at the long-term chart, there's the engulfing pattern of the last couple of weeks for EEM. You know, it's a pretty bear. I mean, even though this is a bullish pattern of intermediate confirmation signal, getting a cluster that far above the moving average and this engulfing pattern suggests emerging markets may be in for a period of weakness too, and there's your developed markets kind of showing the same thing. If you take a look at what do I want to look at? The commodity prices I want to look at as well. You can see again a second week, this time with the intermediate line down there. So you've kind of got this make or break pattern showing up here on all these other things too, with these intermediate confirmation signals. But I think we're kind of in that mode right now of pulling back towards and filling in these wide gaps. This is on a weekly chart, mind you, between where we're at and that 30-week moving average on the market forecast indicator. Finally, let's take a look at the yields, because during this period you expect weakness in yields, and that's kind of what we're seeing here. We came close to a cluster. We're far above the moving average, starting to make our way lower. In fact, if you look at it on a daily chart, the 23% retracement we did get below on Wednesday. We bounced back up the last couple of days, so we want to keep our eyes and see whether that short-term bounce ends up being the peak, and we end up forming a lower near-term high and then roll over to a lower near-term low. Again, we'll find out really, really early next week if that's going to be the case. All right, really quickly, I did want to show you this chart too. I forgot to pull this up, but these are the main ETFs with all the major economies are out there. Look at all the pink shading, right? So nothing is green right now. So it's up broad, and you got a lot of dark pink shading in France and Italy and Brazil and Canada and Russia. A lot of red line and dark pink shading here. Not to, needless to say, you're really close on India and Japan and Germany and UK's got red line, but those two are light pink shading and yellow lines. Korea, light pink shading and yellow line. China had made a little bit of a rally, but it's pulling back towards its moving average. So you can kind of see the broad weakness here. And if I take a look at it on a equity or sector standpoint, so let's take a look at the sector 12 grid. Lots of pink shading showing up here too. Light pink on the broad market, light pink and yellow lines across the board here in these cyclical areas, but dark pink and red line on a lot of these. Energy, materials, industrials, staples, they were also bullish. And financials is not a red line yet, but it's starting to roll. The market forecast is below 40, the 40th percentile now. And you can kind of see the direction it's heading, even if utilities and real estate and healthcare are kind of holding up with their safe haven attributes. So it's a pretty broad broad selling going on across the board. If I take a look at how these sectors, remember these small cap sectors had the biggest. There's energy, materials, financials, industrials, all had the biggest gains to give up going into the end of this week. If you take a look at how they performed this week, energy down 6.5%, materials down 5%, financials down 4.5%, industrials down 4.25%. But and even discretionary was down, and your other cyclicals are down about 3%, and your safe havens holding up. This was a risk-off week from a sector standpoint, and you're seeing the broad rolling over all across the board here. I had this chart up here, but when you look at the relative rotation chart, and let's go to a daily chart on the main sectors, the S&P sectors that are out there. So let's update it here, and here's the daily chart again. So update it, and you can see what's going down to the left: materials, financials, energy, industrials, all going, including discretionary, all going down to the left. Look what's going up to the right: real estate, communication services too, staples. Technology as well moving up. But remember, they were going to move up at the beginning of this intermediate pullback because they had been underperforming during the tail end of this intermediate rally, since really their whole intermediate rally, since the October low point there. They've been underperforming. So right there, right where my cursor is. So they were going to go up simply because they've been underperforming for so long, and on a relative basis they're going to outperform, even if they're not on an absolute basis going up. But on a relative basis, there's utilities, there's real estate, there's staples. You can see the safe havens working their way up to the right with everything working their way down to the left. Pretty decent sign that a rotation has taken place. Again, not a big one. So don't get caught up in, oh no, markets are in turmoil. Markets are not in turmoil, nor will they be in turmoil. Even if we stayed down and messed around for a month or two, that would not be turmoil. It might be turmoil for Robin Hooders who are looking for the next big short squeeze, but the reality is it's not turmoil. And in fact, it would be good for a good exhale so that we can take a good inhale afterwards. But you can kind of see it visually here on this chart, that rotation beginning. And again, another sign that, if not for a day or two of strength, a little bit of strength early next week, that probably by the end of the week, we're moving past this make or break point that I told you about earlier. All right, so that brings us to our trade idea of the day, and I wanted to take a look at Dow Chemical. So Dow just barely came out with its earnings here. So DOW is the symbol, ticker symbol. Just came out with its earnings. It was already kind of in bearish mode. We've been in this intermediate decline coming off of that October Halloween low point. This intermediate run has had more light pink shading than like the broader market has, but still no dark pink shading and red line for an extended period until looks like now. We are, a pretty decent chunk of change down below the moving average. I think it's about 6% or so. We got dark pink shading and a red line. You look at it, it's 3 green arrows. On a 2-line basis here, they all obviously are 3 red arrows. We're well below the 17-day and staying below the in fact, the 8 and the 17-day, the 8's crossed below the 17, which means the MACD is crossed below 0, and they're both crossing below the 30. So, I mean, we are in some, pretty decent bearish mode here. The directional movement index tells us we are getting a directional move, above 30 on the negative, below 20 on the positive. The ADX is rising. It's below 20, which means we could get an extended move, extended directional move. We are in the lower quartile, have been for a few days in the lower quartile, the Bollinger Bandwidth. It doesn't look like we have a very long, there's not a big directional move to the downside because we're getting pretty close to the value area and the top of the value area where the point of control is. So there's other bearish trades we've done before where it's like, oh, we could really get going here and fill in a gap in volume. Not so much here. You can see the strong bullish trend we had got broken. We are into the cloud. We broke below the blue line and stayed. So lots of negative indicators suggesting we are on a bearish intermediate pullback now on this stock. In fact, from a Fibonacci retracement standpoint, we are definitely on one because you look at we are well below the 23% retracement. We are well into the retracement zone, and you can see the blue line is back out of the retracement zone. The blue line is my break even for the trade idea. So let's take a look at what we did. We sold the 55 call, bought the 57 call. The 55 call is right there in the mid 30s on the delta, bought the 57. That gave us, I believe we got 49 cents. Looks like we got about 52 cents actually by the time all was said and done there. Yeah, about 48 cents, sorry. I can't do my math. 48 cents of credit. So about close to that 49. 47 is what we need. So we got at least what we needed there. We got a full position size because we don't have to worry about earnings. And we got a good return, 30% plus return for the risk we're taking. And again, that blue line I told you is the break even. So as long as we've rolled over, and you can see this is why I put the trades on in the market outlook video, because since we put it on, it kept going down. But as long as we stay down, this gap, this runaway gap that we had holds, then we stay bearish. We keep our money. If it starts to break back above that level, back into this area up above today's high and above yesterday's high, the green dotted line, and back into that gap as if this didn't happen, then we'll get out of the trade with hopefully no more than a $336 loss, since that's the amount of reward that we're shooting for. All right, so that wraps us up for today. So you've heard from me now. Now I want to hear from you. Use that link to go to our Market Outlook forums. That's one of the things you get with your free subscription is access to our Market Outlook forums on our community. All the rest of our community is for our premium subscribers. So that one you get with your free subscription. So let's participate there with the rest of the viewers that watch these videos. So post any threads with any questions or comments you have. Reply to other people's threads, and let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Have a great rest of your weekend, everybody, and we'll see you all on Monday.